evening, Investors Guide on ET. Now, thanks for staying with us. Virendra is still with us in our Delhi studio as well, and we're going to talk about the Reliance Equity Opportunities Fund right now. Now, before I ask Virendra for his opinion, Avan is here as always to give us a quick introduction into this fund. Avan.
Reliance Equity Opportunities, our fund under the scanner this week, invests in domestic companies as well as stocks listed overseas. The fund manager can pick stocks across sectors and market capitalization. Simply put, there are no restrictions. Though the fund made its mark over the last few years in terms of annual performance, its track record has been spotty. Launched in 2005, it started off on a good note and went on to be a top performer in 2006. But in the 2 years that followed, it failed to impress. It has so far given its investors an annualized return of 20% since its launch. The fund started off with a large capital but has moved towards smaller companies. This does give it a risky tilt when compared to other equity diversified funds. Let's dig up some numbers now to give you a better outlook. If you invested 1,000 rupees in this fund when it started, you would have 3,305 rupees today. So is that a convincing enough argument to make this fund a part of your portfolio? Let's find out.
Thanks, Avan. But then if we look at the Reliance Equity Opportunities, 20% return annualized since its launch has not been a very bad performance. But do you think this concept of no restrictions on the fund manager has worked for this fund?
Yeah, this fund has, among the very few, more consistently performing fund from Reliance. And it has worked. A multi-cap fund which can go anywhere. And, it's trying to capitalize on any special situation. And they have done it well with this fund. And it shows, some kind of emphasis in the portfolio is clearly visible. Sometimes it is quite contrarian relative to other funds in other equity funds. And it has worked out very well over the past 3 years.
It has about 51% of its investment right now in small and mid caps in a market like this. So what sort of return do you really expect from this fund going forward in the next 1 year, especially with the volatility that we're seeing right now?
If we witness a turnaround in the market anytime in the next 1.5 years, then this fund will be a key beneficiary and it will top the charts. And through these difficult times, if it is able to, guard the downside, do little okay, what it has been doing, it has lost in recent times, but that's okay. In a crumbling market, no equity fund will be able to, withstand the kind of decline we have seen. So this fund could be a big beneficiary and it is navigating the difficult times well. So I'm extremely optimistic even now.
All right, then finally, your rating in the Reliance Equity Opportunities Fund, should we be investing in it, especially in a market like this?
In a market like this, my suggestion is based not on this market or any other kind of market, but should it be a good equity fund to hold for the long run and continue investing? Yes, it will be. I'll give it a 5 star.
5 stars there for the Reliance Equity Opportunities Fund on Investors Guide. We don't see 5 stars coming in on one of our reviews very often, so you can jot that down. Now, moving on, we all know that the inflation number this week came in at 9.78. That's the highest it's been in over a year. And that also means very high interest rates. And with the stock market seeming unstable, we know you've been considering debt investments like fixed deposits. But the other option that seems to have caught attention is NCDs, or non-convertible debentures. Now, they're currently being offered at 12%, sometimes higher. And while that seems like a really good deal, there's more to an NCD than just the rate of return. Here's a report that breaks down these products piece by piece to find out if you should really be picking that NCD over your fixed deposit. Take a look. If you prefer investing in fixed income products like bank deposits for the security they offer you, you should know there are more options out there. Corporates in need of capital are raising funds through non-convertible debentures or NCDs.
It's generally for a fixed term, and it carries a coupon rate, which is basically the interest rate, which is paid on a quarterly, half-yearly, or a yearly basis. End of the term, the money is refunded back to the investor.
Now that sounds a lot like a corporate deposit, doesn't it? But there is one fundamental difference between the two products. An NCD, unlike a corporate deposit, is tradable.
Think about a company deposit as a fixed deposit from a company, and an NCD as being a more, more institutional vehicle which gets listed and which has some amount of more flexibility and can offer better coupons than a company deposit.
Now, because you can sell an NCD before its term is up, it offers you better liquidity than a corporate deposit or a bank fixed deposit.
In case of fixed deposit, say if you open a fixed deposit with a bank or their corporates who offer, if you want liquidity, you have to go back to them and then break the fixed deposit and money comes back. When it comes to non-convertible, when it comes to debentures or bonds, these are traded on stock exchange and they can be transferred. So if you don't want that, you want to sell it off, you can transfer it to somebody else.
The biggest difference between an NCD and a bank deposit is the security. While a bank offers you security on your money, there is a risk that the company that has issued the NCD might default on the product. Which is why these products are rated by independent rating agencies. Ratings range from AAA, which indicates the highest security, to D, which indicates likely default. So if you plan to invest in an NCD, here's a checklist that you must use.
First is look at the safety or why that is being launched. What is the purpose of that money being borrowed. Second is the rating if that's available. Third, tenure. Fourth, rate of interest. Again, these are not in order of priority. So you have to look at all those things.
First thing to look at is the background of the company and the reputation. Secondly, one should look at the gearing ratio, gearing aspect as to the debt equity ratio, and that should not be too high. Then we need to see whether what is the interest cover ratio? Just to ensure that the company can service the interest payable on these series of debentures.
And finally, you must remember that the money earned from an NCD will not attract capital gains tax. It will instead be taxed as part of your income. Alright, so make sure you check the rating on any NCD before you buy it. And if you have any questions about what you heard on the show, you can write to us on the email ID at the bottom of your screen. Virendra, thank you so much for joining us on Investors Guide and answering all of our questions. Coming up on the other side, the Managing Director of Civil, Arun Tukral, is going to come into the studio and answer your questions about your credit report. So don't go anywhere.